Welcome to Everything Money. We're glad you joined us today. Today we're talking about Alibaba. This is a fantastic Chinese company. Fantastically popular is what I mean to say. We get a lot of requests for this company. Paul has some hesitations about investing in Chinese companies in general, especially when there's elements of potential fraud out there. And this involves politics and leadership, Paul. So maybe we can double down. Give us your thoughts on that for our U.S. investors to maybe have an eye out on some of these companies. But in general, in this video, we're going to look at Alibaba, their new quarterly earnings, why there's some excitement about this, and why the stock price has gone down 30% in the last 6-8 months. It's incredible. So is it a time to buy? We're going to figure that out right now. Paul, give us your stance on some of these Chinese companies and why you're mindful of them.
So I love Alibaba. We have several online businesses where we source from overseas, and our original sourcing came from Alibaba. Great way to find some manufacturers. They do a great job of protecting buyers here in the U.S. from buying from them. Now, when it comes to international numbers, there have been concerns in the past, and as time goes on, it will decrease. But there have been concerns in the past about the legitimacy of numbers coming out of China. Now, I don't say it from a xenophobic standpoint. I just say it from a reality standpoint. Alibaba is a bigger company. Alibaba does have auditors all around the world, some of which are US-based, so it makes me feel a little bit better. But I would be remiss if I didn't bring up the concern that I had about a lot of data coming out of China. But Alibaba is a great company in the sense of what they do. I've personally used them. I enjoyed the experience. I think their website's very attractive, not really, but they have a great way of protecting buyers of goods on their website. So when we're talking about this company, it's a very large company, but as you can see from this chart, this is October. It was at $320 a share, and now it's at $216. Got as low as probably $205 or $210. That's an over 30% drop in the price. So everybody who was all hype on Alibaba for a long time, paying a huge multiple, now sees this big drop. Over time, guys, things will relax on hype companies. So let's get started. This is now a $600 billion company, okay? Their PE is 27. So it's still an X here on PE. Still a high PE. They claim to have a lot of growth potential, but it is a large company. Now, profit margin. Skip the last quarter here, but right now their profit margin for the last 12 months is about 22%. Call it 21%. $22 billion on $106 billion in revenue. That's a big check. No dividend coming out of Alibaba, which is not surprising to me. But so far we have one X and one check.
So what Paul's doing is using our 8-pillar analysis to analyze the fundamentals of a company. We came up with this a couple years ago now, Paul, and people are really flocking to it. So we did pillar number 1 and pillar number 2. Pillar number 3 is revenue growth over the past 5 years. I imagine they're slaying it.
So look at this, Seth. $23.5 billion to $106 billion. Massive check mark. That is almost 5 times growth. It's like 4.5 times growth. That's a huge growth number.
And then pillar number 4 is the profit growth along this line. How's their profit doing?
$6.5 billion to $22 billion. Check mark. So one thing I'll note, profit's only up about 3.5 times, even though revenue is up 4.5 times. I don't know why that is, but just keep that in mind here when you're looking at this.
So pillar number 5 is shares outstanding. We want this number going down. What do you think they're doing, Paul? I would imagine they're not buying back shares, are they?
They are not. Their shares outstanding is an X, 2.5 to 2.7 billion. That's an X. So this is one of the most important pillars because people don't really get how important this one is. This is the way that the companies dilute you, okay? As they issue more shares, they're giving you a smaller and smaller piece of the pie. They're taking the revenue and profit and dividing it up amongst more people. So let's say a company has 10 shares, you own one of them. You own 10% of the business. They all of a sudden increase 2 more shares. You still own 1 share, but now out of 12 shares, which is 8.33%. So you went from owning 10% of the business, you did nothing but keep your share, and now you own 8.33% of the business. This is a silent killer in stocks. So this is an X. Kind of an important one, but it is an X.
Yeah, okay. Pillar number 6 is current assets over current liabilities. We have 2 X's and 3 checks. Go ahead, Paul.
So right now they have $98 billion in current assets, and current liabilities stand at $57 billion. That's good. But look at this, Seth. Their total liabilities of $93.5. So they have enough cash on hand to pay off all of their debts. This is Checkmark City. This is a phenomenal thing. That means you would have enough money in your personal checking account to pay off all your mortgages, your car payments, student loans, credit cards, everything you owe in the world be paid off with one simple swipe of the check.
Why is this good if we have an economic crash? People ask us why we get into these type of companies that have some of our great pillars. What can this do for a company if there's a huge correction?
Well, let me ask you this question. Is a company more or less likely to go bankrupt if it has more cash on hand than all debts?
That's what I wanted you to say.
Well done, Seth. So Warren Buffett has always said, I've seen brilliant men go broke, and it's always because of debt, right? I'm a fan of debt. I have real estate. I'm okay putting debt on things. All of our operating businesses upstairs, we have 8 to 10 operating businesses upstairs. We have no debt on any of the operating businesses, the non-real estate businesses. Because I sit there and say, we should be able to grow a business and get a good return without using leverage to do so.
I think this goes along the lines of downside risks that you've tried to taught me.
Yeah.
I'm still trying to learn is like when we crash, we've been criticized on this channel because we get into companies no one's ever heard of. There's not a lot of hype around them, but their numbers are solid. And so these numbers can really help them during a correction, which is all involved in downside risk, right?
You know, I read a lot about the Great Depression and how many companies went under. And the ones...
Before you even say that, just by saying that comment, you get roasted below. It's like, come on, dude. It's not 1988 anymore.
1988, 1928.
Any year. They just say it's not. It's
a dollar is still a dollar, whether it's 1900 or 2000. Yeah, did that dollar buy more back then than it did today? Absolutely. But if you think that, isn't it weird that over 150 years of stock market history, the same things play out every single time? Yeah, there's a different story here or there, but the same valuation, the same numbers. It's still, if you go look at 30, 40-year time periods starting in 1870 and coming up to now, the returns are very similar. It's just, if everybody wants to use that excuse of, oh, times are different, great. There's a great book over here called This Time It's Different. It's actually a book, makes fun of people who always try to justify higher values by saying it's different this time. Okay, it's different. But at the end of the day, you're still gonna get a return based on dollars coming in, dollars going out, whether it's 1900, 2020, 1700, or 2400, whatever. You're still gonna have money coming in and money going out. And at the end of the day, it's all about rewards and ROI and IRR.
So stay tuned as this video progresses. Trader Mo is here. The silent killer in the background, our Egyptian dreamboat. He's going to go over trading Alibaba. So we have a fundamental aspect for long-term holding. And if you want to trade this on a 15-minute chart or a weekly chart, Mo is going to be at the end of this video showing that awesome Bid and Ask Nation, that middle Patreon tier, how he trades on a daily basis. So stay tuned. Paul, we are at pillar number 7, which is free cash flow. You love this.
Okay. So for some reason on Y charts, we don't have the most updated free cash flow numbers. So I'm going to go back to the previous year. We have 7.2 billion to 19.4 billion.
Jeez.
So check marks there. And then in between, we have 9.6, 14.5, and 15.1.
So the average free cash flow over the past 5 years for Alibaba is about 13.1 billion.
Okay, so what we do here is we multiply by 20. What I'm doing here is picking a starting point. This is not a set point. When we have free cash flow increasing and a multiple we want to pay is low teens or lower, but as you go further back in time with increasing free cash flow, you have to give more value to most recent years that might be much higher. So our average here is 13.1, but last year was 19.4. So I'm going to give a higher multiple. So that says the company should be worth about $262 billion.
Yep.
So it's an X because currently the company is $585 billion. So right now, based on paying 20 times free cash flow over the last 5 years, you should pay $260 billion for the company. Now, with that said, last year was 19.4. If you thought for sure that last year's numbers would stay the same or get better as time goes on, I think that paying 262 divided by this is roughly 13 times free cash flow for a company like this is too low. This company has a lot of growth potential. As the world expands and gets bigger, they're going to be expanding to other parts of the world. I still believe Africa will be the next frontier of manufacturing and production in this world. Why? Cheap labor. China's getting wealthier and wealthier. India's getting wealthier and wealthier. As the labor costs go up, what happens in manufacturing?
Increases?
It gets exported to cheaper places.
Oh, I see. Okay.
It's cheaper to ship. I mean, you've seen those boats.
Yeah.
They ship these containers. You can make 10,000 items, put them in a container, and ship them off somewhere. So I do believe that Alibaba will be around for a while. and I look at this saying, do I believe 20 times free cash flow is reasonable? No. I think it's a little low. Do I think 25 or 30? It's currently selling for, Seth, what's 585 divided by 13.1?
44.6.
So 44.6. And what's 585 divided by 19.4?
30.
So currently selling for 30 times last year's free cash flow, which is high. But if there's a lot of growth potential, remember, all investments are based on the potential and the assumptions we make about growth. The higher the growth level, the more you should pay for the company. One of the most common criticisms I get on this channel is Paul doesn't care about growth. Exactly the opposite. I'm not willing to overpay for growth. So part of our software will include a stock analyzer tool that will allow you to make assumptions on free cash flow growth in the future and decide what are you willing to pay to get the returns you want. Where do I think this company is worth? I still need it to go down quite a bit. I would say this company, remember, they're diluting their shares. They're diluting their shareholders, which is always a concern of mine. Do I think I need to pay probably in the $300 to $400 billion range?
The market cap is currently $600 billion.
Correct. So it needs to fall by at least 33 more percent. So right now it's 220. I'd want it to be sub 150 before I'm taking a look at it going, all right, let me take a look at this. For those of you who get upset about that, in the last year and a half, it's been there easily. And these stocks, look, it's already down 33% since its high in October. Things happen, and things can happen very quickly.
It was 150 on June of 2019, so almost 2 years now.
Okay, 2 years now.
Yeah.
But it's down 33% since, if I told you 6 months ago that it was going to drop 33% after you saw it sharp, what would you have said?
You said, obviously, this is a growth stock. You would have been crazy. And
yeah, there's no way it's going to go down. It's down 33% now.
Yeah. If you're interested in trading the stock, Mo, the expert trader, is here, and that Bidnass Nation following him in our Patreon. Mo, what's going on with Alibaba? Look at all that red. What's the story over there?
So this is an interesting one. You actually have kind of two 50% rules here. You have one here, and it tried to rebound and couldn't. And now, so this is 7 months out. Now we're here. This is kind of another 50% rule. This is not very common. So you have like overhang right there and overhang right here. So they have a lot of work to do. Obviously, they're in a very downtrend right now, but this is something to keep an eye on. I mean, if you want to, this is going to go on my watch list. I know that. And if I can get some kind of positive trend, this thing moving from 215 more towards that 260 number, I mean, it's Alibaba. There's a lot of volume that comes into it. Everybody wants to own it. Maybe not right now, but they're coming to that point. So this is for sure a stock that I'm going to keep on my watch list, but just be very careful of both of these 50% roll patterns. It's even more powerful than before.
Yeah, and that bottom right there, it looks like we're in a waiting period, right? We need that red to cross back over.
We need red to cross over, and we also need this red line to cross over the 32% line. So we have a lot of waiting to do, but right now it's at a very strong support level. So hopefully it holds right there for the sake of us, and we can go ahead and buy this thing. And
yeah, it does have some room to run there, Mo. Look at that. If we get back up there,
I mean, if it can break through this level, the next level would be up here at 320, where it was back in October or September, and you would make a lot of money on this trade.
So with the Q1 earnings being so well, Paul, why would the stock be down?
Momentum shifts, hype shifts. That's just the way, that's what we're trying to teach. The different is hype and momentum are different than what's behind the company. We look at the fundamentals of the company from my perspective, and Mo looks at it from a chart perspective. So Mo's perspective is he doesn't even care about the fundamentals. All he looks at is how are the prices changing day to day. That speaks to you, pay more attention to that. If what's behind the company, the balance sheet, the financial statements, the cash flow is what speaks to you, listen to this part. It's just all about what you feel makes most sense to you when looking at a company.
If you're new to our channel and this resonates with you, it certainly started resonating with me. I used to argue with Paul about this, about how to, literally, I was so stupid. I would tell Paul how I would invest, how my friends told me to just invest in companies I really liked. And there's a lot of misinformation on YouTube about investing. But if this idea of looking at the numbers speaks to you, then go ahead and join our Patreon below. Take a look. If you've never joined a Patreon, it's quite simple. Click the link in the description below. You'll join our community. We hit 2,700 members, Paul. Incredible as always. And we have a group of like-minded people who might be in Alibaba for the long run or are trading it on a daily, weekly basis. Both are there. And if you need a community to talk to, we're here for you. So Paul, final take on Alibaba. What do you think?
I'm waiting for it. It's a company I like a lot. I do think there's a lot of growth potential, but I still want to buy. Remember, I'm a value investor. I want to buy $1 for 50 cents or 60 cents. So I need to wait for this thing to hang a lot lower than it is today.
Click around on our page and see more videos, and we'll be showing off the software you get as a patron. We didn't use it today because it's obviously a foreign stock, but yeah, it's incredible. So we appreciate you guys watching. Comment below and see what you think, and yeah, we'll stay tuned to Alibaba from a trading perspective and a long-term value play. So that's our take. Take a thumbs up on the way out. See you guys. Love you.